Hello! So, a viewer of the channel had an interesting suggestion to take a look at Nintendo, a very well-known company, a known gaming company worldwide. And I found it interesting because we have examined some gaming companies before, yet Nintendo is not talked about that much. And so I thought, okay, let's take a little bit of a closer look at what's going on with the company. And obviously, you will see here that Nintendo is actually trading in Japan, but it actually has ADRs, which is basically stocks that are adapted for the US market. And you can buy Nintendo using the NTDOY ticker symbol, which is an OTC stock. And so you will not find it in one of the big exchanges, yet still you can actually buy it. And so, since this is traded, I wanted to take a little bit of a closer look and see what's going on with the company. So, what about the outstanding shares here? It looks like they're actually going down. So, company looking to be buying back shares, which is always a good sign. So, boasting a 17 times forward PE, which is very, very interesting here. And the current one is actually a 14 times PE. So, this is projected to be higher, actually. And the company's stock price hasn't been going anywhere since 2007, really. It's actually down. If you bought at this level, the company is actually down right now. And this is why it pays to buy at lower levels. This is why it pays to buy here and not here. And this is why we're examining companies and taking a look at the financials in order to discover whether it's a good potential buying opportunity. And that depends on the price of the stock as well. It's not only about how the company is doing. It's a combination of the two things. So the company is not paying any dividend here, and it has a low price to book ratio relatively. 3.5 is pretty nice. Anything below 3 even is actually awesome, but 3.5 is pretty great as well. Now, take a look at the income statement of the company next. You will notice that the company had very, very variable year-over-year growth here in terms of its revenue. Yet it's pretty much always increasing, and when there is a slump, there's like a minus of like 1% or something of that sort. So it doesn't really go down that much. It typically tends to be increasing over the years, which is a nice thing to see. Again, typically it can go down a little bit in some situations. The gross profit as well. But let's take a look at the net income, which is what stays with the company really. And that is also growing. And there is a little bit of a slump here again, like the last 12 months, but that's insignificant really when you compare it to the previous years where it used to be 1 billion and now it's like 4 billion. So it has quadrupled its net income in like 4 years time. So that's awesome. Balance sheet. And we also saw that they are not really selling more stock. And so when we are looking at the balance sheet here, we're probably going to see a very nice picture that actually shows us what the company is making organically and not just by selling stock to investors. So the total assets of the company also growing nicely with the company's operations. Nice to see. And a few liabilities as well, sitting at $5 billion for total liabilities. That sounds like a low number, especially for a company like Nintendo. And remember that this is adjusted for US dollars, so it is on USD. And the total equity of the company from 11 billion in 2017 to 16.7, very healthy. So company increasing liabilities. And you will see here the additional paid-in capital is almost zero. That's because they are not printing more shares. And this is very, very nice for an investor, really. Cash flow. So the cash flow from operations used to be 170 million in 2017 and it's now 5.5 billion. That's a massive growth. That's massive growth here in the last couple of years, really. That's great to see for Nintendo. And they're investing a little bit. Also a nice thing to see. Company investing in the stock market is something that I generally like to see. They are buying equities really and marketable securities here. And a little bit in capital expenditures, okay, very normal. And in terms of financing, they're not getting any more debt here. They're basically paying back some dividends here. And I didn't notice that they actually are paying some dividends. That's good to know. We can actually examine it. And let's actually take a look at that before we continue. Take a look at the dividends here. What kind of dividends are they paying? They are those like special dividends, or they maybe started to pay dividends lately actually, just to attract some investments over here. Very interesting. We don't have enough data for this, and yeah, this is very semi-annual here and an annual. Okay, interesting. I don't know if this is gonna be a regular dividend. I don't think so. Maybe this is something that we potentially want to take a little bit of a deeper look here. But if I judge from the cash flow here, I can actually kind of see how much they're paying. And you will see here that, let me find it, cash from financing it should be, yes. So they paid 1.7 billion in common and preferred stock dividends. And they made 5.5 in operating income. What about the free cash flow is what I want to say. Well, the free cash flow was 5 billion, 5.4. So they paid like 30% of that, 25% of that, actually, 1/4 about. That's fair. That's very easily paid for from the free cash flow. Okay, and nicely seeing here that the free cash flow is basically as much as the cash flow from operations is, because they have very very little capital expenditures here, because it's a software company, and this is great to see. They are increasing their free cash flow massively here. And if that continues, they don't have much capital expenditure, so everything in the operating income stays with the company pretty much. So that's fairly awesome to see. And the company has a market cap of 60 billion right now, and probably a 3-year average, let's just say, of $3 billion here. And so if we give it a multiple of 20, we're actually reaching the market cap, which is 60 billion. And this would take it to a fairly priced company here. At its current valuation. Yet I do like the fact that they are increasing the free cash flow and massively, and this seems like a very very interesting opportunity actually, to tell you the truth, for adding the company like that. And you will see here that the multiples are pretty low, and they were lower than what they used to be in 2017 actually. A lot of those multiples, and that's good. The lower the better for us. Profitability, very fair, return on equity of 25%, 26 almost. So that they won't have much, yes, as expected, and we kind of examined that earlier. We don't have entries here, but still we know how much it isn't. Very interestingly, the total liabilities of the company, remember they were, let me find, about 5 billion here. And the company actually made 5 billion in free cash flow in the last 12 months. So they can actually pay their total liabilities just using the free cash flow of the last year, and actually less than that. So it's actually less than 1 year of free cash flow. The total liabilities of the company has practically no debt really that they can not repay very very quickly. So no problems there at all. You know, I like what I'm seeing here a lot. I mean, the company is looking good here, and it has dropped almost 20% already. And it has reached the point where it's becoming an interesting buy, to tell you the truth. Especially here, it would be much even better at 55, because of some margin of safety, extra margin of safety here of about 10% must have been that drop back in $55, about that. So at these levels is 100% a buy for me. Even at these levels though, I kind of like it. I mean, I would potentially look to add a little bit of Nintendo here, just because I like what I'm seeing in the increase of revenues and all that. The only thing that I don't like is the fact that I'm looking at the estimates, which are painting a worse picture here, like the 17.1 PE here, for example, looks a little bit worse, and the year-over-year change in the projected year-over-year change in sales looks lower. So maybe we're gonna have a little bit of deflation happening for Nintendo. Yet I wouldn't mind adding a little bit here, just because of 20 times multiple for Nintendo, and maybe even getting a little bit of a dividend yield throughout the years. I would be happy with adding a little bit of Nintendo here. I think I would. So it would be a buy for me. Let me know what you think. Do you actually own it? And are you thinking about it? Let me know. And if you did enjoy the video, take a look at this one that I made earlier, and it's about Alibaba and what's going on with the company, whether it's a good buy or not. Thank you for watching this one. If you did like the video, please leave a like and subscribe, because that really helps a lot with the growth of the channel. Helps me make more videos for you. And you can also join our Discord channel. You can find a link in the description box below. Thank you for watching, and I'll see you very soon. Bye bye.